Welcome. Thank you so much for being here today. We really appreciate it. I'm super excited to kind of teach you guys a little bit about the strategy lab, walk you through how to build a strategy in the lab on Tesla. But before I get into talking about Tesla specifically and the lab, I want to take just like 1 or 2 minutes and talk about why the AI strategy lab exists. I have to assume that at least a few of y'all are first timers. You've never seen this tool before. So everything that you're going to be learning today is going to be brand new. And I want you guys to have a decent understanding of why it exists. So we built the AI strategy lab to help bridge the gap between complex trading systems and accessibility for traders at all skill levels. Building a successful strategy traditionally requires a few key things. You need a pretty deep understanding of technical analysis. You often will need programming skills. And then, obviously, countless hours of backtesting. For many traders, this complexity in and of itself is enough of a barrier to kind of like keep you from wanting to even try. The AI Strategy Lab seeks to eliminate some of those bigger obstacles by using machine learning to automate what really are the hardest parts of strategy creation, which is deciding when to get into trades. The lab is purpose built for helping traders uncover insights and patterns in financial data that might otherwise go unnoticed. By leveraging AI, it removes the need for us to manually define every particular rule or indicator threshold, and instead, it allows us to focus on the bigger picture, which is identifying opportunities based on the AI's driven insights. Now, with all of that said, I think it's important to note that this does not mean that the lab will just instantly feed you great, profitable strategies. As you're going to see in today's presentation, each piece of the model creation process in the lab can really benefit from careful consideration. So your current skills as a trader can and really should be put to use as you're developing models in the lab. That's exactly what I'm going to do today. And hopefully you, by seeing the way that I do this, it'll inspire you and get you excited about trying it for yourself. So with that said, let's get into building a model. The first thing that you do when you go to build your model is you define the asset that you want to train the model on and the data of that asset. Now, you're probably here at least in part because we put Tesla in the title. Congratulations to all of the Tesla longs in the house. New all-time highs today. Uh, I'm clapping for you over here. So you already know the asset that we've chosen to utilize today. It's Tesla. Choosing the training data, however, can be a bit of a tricky task. Generally speaking, if you want to create a durable model that will provide signals during various types of market conditions, you're likely going to uncover better models if you train them on a diverse or varied section of the price chart. When it comes to beginner builds in the lab, and let's be honest, like we're all beginners, right? This tool's been around for just a couple of weeks. But when it comes to your first time playing around in it, we really recommend this approach of choosing a varied section of the price chart. Once you become more familiar with the tool, by all means, you can dig deeper into more specific sections of the chart. But for today's build, let me pop over to the chart here. For today's build, I decided I'm using the 4-hour chart so that you guys can visualize it. And I picked this section from essentially June 1st of 2022 through July 1st of 2023. Now, why did I pick this section of the chart? The reason why is because simply it offers quite a bit of volatility, and that volatility is occurring in both directions, higher and lower, right? It's got a little bit of everything. It's got various consolidation phases that resolve both higher and lower. You've got these nice strong uptrends that have pullbacks throughout, this one and this one. You've got this nice strong downtrend that has these big bounces throughout it as well. Now, the only thing here is that the 4-hour chart, I personally trade on a lower time frame. So the 4-hour chart is a little bit too high of a time frame for me. I like getting a lot of data, and on the 4 hour chart, you're just not going to get as much as if you go to a lower time frame. So my thinking was, use the 4 hour chart to find the section, and then I'm going to utilize the 1 hour to train the model. I'm still going to use those parameters, June 1st, 2022 through July 1st, 2023, but I'm going to do it on the hourly chart. So I need to set all that up. So in here, I'm just going to choose Tesla. It's already preset to the 1 hour. And then I'm going to say June 1st, 2022 through July 1st, 2023. That's correct, right? Yeah. Okay. So the next thing that I need to do is I need to define my prediction horizon and my reward to risk settings. Now, as I said at the introduction, in the lab, we don't need to define the specific things that get us into our trades, right? The AI is going to do that for us automatically. But we do need to define a window within which we think or we hope that our profit goals can be met before our stop loss gets hit. So while this piece seems like pretty cut and dry, there is actually a lot of nuance that can be taken here. And I want to discourage your first thought being like, I just want to, make the most amount of money in the shortest amount of time with the lowest amount of risk. So meaning like a high R with a short candle window. We all want to capitalize on trades like that, but we really first need to consider what's realistic to the asset that we're trading, right? For example, some questions that I'll ask myself, when Tesla bounces, what percentage does it bounce and how long does it run before reversing again? When it makes a new higher low, how far does it tend to extend before reversing? When it reverses, how much does it give back before ultimately reversing yet again and continuing in the direction of the previous trend? If you want to go even another layer deeper, it's worth considering analyzing how those percentages compare as it relates to the type of price action that's happening, right? You might get bigger moves during uptrends than during downtrends or during sideways sections of the chart. The point that I'm trying to get at here is that we can loosely gauge our take profit and our stop loss values by simply taking a little time to measure different moves on the chart. This process doesn't have to be perfect. We're just trying to gain a very loose understanding of how price action tends to work and what kinds of moves we should expect. So that's actually the first thing that I did. Using that section of the chart that I defined, I measured a bunch of random up moves. Reversals off lows, extensions off new highs, bounces during downtrends. They all seem to yield, just the random ones that I picked, they all seem to yield somewhere in the neighborhood of 4 to 7% before reversing lower. So this gives me a roundabout idea of what my take profit percentage could be. I want to stay on the lower end of the range. I want to make sure that I can actually achieve those percentages. So I decided to input 4 as my take profit. Now, the second piece is we need to think through how long we want to be in a trade for. How long should it take that 4% take profit to hit? Again, we can go back to that same chart and we can see how long it took, right? In each of these text dialogues here, you've got a dollar change, a percentage change, and then the actual how many bars from that point. And in most of these, you'll see it was somewhere between 1 to 4 bars. Now, remember, I'm measuring on the 4-hour chart here, but we're utilizing the 1-hour chart for training the model. So the moves are happening within 1 to 4 4-hour candles, which means that they're happening within 4 to 16 1-hour candles, right? So with that in mind, I figure let's just shoot right down the middle and set the candle horizon to 10. That seems like a reasonable place, at least to start. The next question we ask ourselves, remember, when price reverses, if you're going higher and price reverses and moves lower, what percentage does it give back before ultimately reversing again? This is how we're going to figure out where we need to be setting our stops. So again, I used my measuring tool to measure from random highs throughout this section of the chart, during uptrends, during downtrends, and sideways action. And I actually found pretty similar results. The moves that I measured, and again, they're just all random points, the moves that I measured were approximately between 4 to 7%, and they occurred within a 2 to 3 4-hour candle window. So again, I'm going to take the cautious approach here, and I'm going to input that 4%, the lower end of the range, as my stop loss. So now our criteria is defined. We've got a 10 candle horizon with a 4% take profit and a 4% stop loss. That's an R of 1. That's very wide. That's not a very enticing R, but it's a reasonable one, I think, to start off with. The next thing that I want to do is I want to analyze whether these parameters that I've just defined, whether they're yielding signals where I'd actually want to see them on the chart. So using this chart here, and for lack of a better name, I'm just going to call this the signal chart. I don't think we have like an official name for this, but it makes sense to call it the signal chart. And I'm specifically here, I'm looking at the yellow candles. The yellow candles represent historical candles in which our take profit can get hit before our stop loss within our candle horizon. And what I'm seeing is a lot of what I'd really want to see. During stronger uptrends, I'm getting plenty of signals. There's some spacing in between them, which perhaps means that my model can re-trigger into trades when momentum is pretty strong. During downtrends, I'm only really seeing signals at kind of key reversal spots at the very bottom. Here we get one. If we pull back in the chart here, I believe there's one other one back here that I can kind of point to as an example. Yeah, here's a good example. You know, in a strong downtrend, I don't want to be getting signals in this, right? But I do want to start seeing signals as it's starting to try and bottom. That's what I want to see. During sideways action, it appears that my signals are occurring at the bottom of the sideways range. So again, like I said, I'm kind of seeing what I want to see. The next question, though, is how many signals am I getting? From my time working in the lab so far, I found it best to look for pops of signals rather than large sections of signals. And I'll show you really quickly what I mean when I say large sections of signals. If I just like change my take profit to 1%, now almost every single candle is yellow, right? The problem with something like this is, is simply that, you know, if I'm getting a signal on every single candle, then it's more than anything can be a signal, right? That kind of, I think, will confuse the AI. To me, essentially what it means is just there's less alpha in each signal. So we really want to find a balance there. And you know, I think that's what we're seeing here. It appears that's what we're seeing here. A nice balance where we're getting enough signals, we're getting them where we want them, but we're not getting too many of them. And remember, this is just a starting point, right? These values can be refined in a couple of different places. You can refine them once you start developing your models. Once you deploy your models and you start strategy testing them, these are our exit conditions for our strategy. So we'll absolutely be able to adjust them then as well. So now that we've got that worked out, the next thing that we need to do is we need to define our model type. Now, in the previous webinar that we did maybe 2 weeks ago with our developer, Russ talked pretty extensively about the different model types that are available and the use case for each. I'm not going to go into too much detail here. My guys are going to share with y'all some documentation, and they're sharing stuff throughout that you guys can learn a little bit more about some of these concepts. But yeah, so I'm not going to go into too much detail on that. I'm just going to say that right now, in my time in the lab, where I'm at with using it, I prefer to use the more powerful models. The most powerful models are the random forest and the k-nearest neighbor. So I just decided to use k-nearest neighbor for this particular build. The next thing that we need to do is we need to define our model inputs. And here, I think it's best, in this particular instance, I thought that it was best to rely first on a pre-made prompt. If you click on this See Examples button, it's going to open up a bunch of different just basic prompts that you can utilize. And if we think back to our previous steps where we were defining our horizon, our reward to risk values, we were measuring on the chart, different sections, you know, we were looking for signals in areas where price was reversing. So it makes a lot of sense to me to then utilize that prompt. The prompt is focus on potential reversal signals for my prediction horizon. So that's what I'm going to do. Now, as this thing is thinking, I want to talk y'all through a process that I like to take. When I have a prompt, I generally will start with one of these pre-made ones in the platform. But what I've found to be true is that you can make small adjustments to the prompt and get completely different models. So The next step that I'm going to take is that, we start with this really basic prompt, but if I expand on that prompt, I'm going to get a slightly different model. It's going to look for the same type of things, but I'm really trying to urge the AI to develop new inputs because I want things to try here. The lab is all about experimentation. So that's really what I'm trying to do. So while this is training, I'm going to just go ahead and get it training. I'm going to click build up on it. I'm going to go back into the inputs that it just created, and I'm going to remove all of them. And in place of those or of those previous inputs, I'm going to choose get AI suggestions, and then I'm going to paste in a new prompt. And this new prompt is pretty much looking for the exact same thing. Focus on identifying potential reversal signals within my prediction horizon. That was the old prompt. I've gone in and I've added something, just a little extra, right? I've given it a couple of indicators to consider, RSI and MACD. I've said highlight areas where the current trend may be losing strength or preparing to shift direction, right? I'm just trying to nudge it towards something slightly different. I want it looking for the same sort of stuff. I just want it thinking slightly different about that process. So again, I choose get AI suggestions. It's going to think about it. If you want to develop your own prompts, by all means, go in there and go wild with whatever you tell it to do. You can also, a methodology that I've been utilizing is taking a prompt and putting it into ChatGPT and saying, make new prompts similar to this prompt and feed those back to me. And that's been kind of cool too, to just play around with like variations of ChatGPT created prompts. So we're going to go ahead and train that model. And once this model gets all trained up, we're going to have ourselves two models to kind of play around with. So we'll let it do that here real quick. And it should usually, all right, there we go. So now we have two models. Let's compare them. These are our two. Both of them are showing promise. That's good. We're being told to go back test on both of these. That's because we're getting signals in these green boxes here. If you see green signals, you're going to be told to go back test. That simply means that the criteria that you defined your take profit is being hit within that candle window. So we want to kind of compare these a little bit. They look pretty much the same. This one is slightly, to me, this one looks slightly better simply because green the green dots are going up and to the right, which just means that as the model's confidence in the what would you call these signals, the model's confidence in the signal is increasing, the win rate of those signals is increasing as well. Now, the next thought that I have is to look at the inputs. In the case of both of these, it looks like stochastic K is the most important input. On this one, the second most important input is RSI. On this one, the second most important input is the MACD histogram. So I already know kind of where this thing is focusing. I want to create a few additional models. And the next step that I want to take here is I want to try adjusting the model inputs that I know are already being used. So I said that this model looked better. I'm curious what happens if I remove stochastic from the inputs and rerun it, have it train it on this same model, same everything, except stochastic removed. Will that help the model? Will it create a better model, a different model? What will happen? Another question I have, what happens if I remove the least important inputs? Theoretically, if they're not that important, if I remove them, maybe that will make this model a little bit more robust. Maybe it will make it easier for the model to find cleaner signals. We don't know. We have to try. So that's what I'm going to do next. I'm going to go build up on it. I'm going to go into model inputs. And remember, I said the first thing I'm going to try removing that stochastic K because it was most important. It was most important on both of these. So what happens if I just remove it completely? We'll go ahead and train that model. And then I'll go ahead in here, go back into build up on it, and go into the model inputs. And I'm going to identify the ones that are least important. It looks like model input E isn't very important. Model input M isn't very important. So let's go ahead and get rid of E and M and retrain this model. Now we have four models that we're going to be able to kind of contrast and compare and see if we've done, if we've created any other interesting looking models. All right, cool. So not a huge change. Remember, these are our first two. And then these are the two new ones that we made. All of them are telling us to go back test. From what I can see here, just right off the bat, I kind of feel like the least enticing one is this one. So whenever I am creating models, I like to just go ahead and like delete stuff that I know I don't really want to mess around with. I want to just to kind of make this whole process more efficient. So I'm just going to go ahead and get rid of this one. We'll delete this model. And so now we have these three. And I could take a couple of different steps here, but where I think to go now is this thing's telling me to go back test. I have no understanding of how these models actually should be performing, how they work. So I want to do that before I start making new iterations of these things, before I start crossbreeding or anything like that. I want to just go ahead and test these. Maybe there's some alpha in these. Maybe these will work really well. I want to try that. So I'm going to go ahead and deploy them. So what we're going to do, we're going to title this Tesla Model 1. We're going to deploy this one and call it Tesla Model 2. And then we'll deploy this one. And we'll call it Tesla Model 3. Cool. So with all of our models now deployed, we are able to access them across the platform. We can utilize them in the strategy tester now. We can utilize them as alerts. We can utilize them on chart. We can scan for them. The whole thing, like they are available across the platform. But remember, we're trying to find a strategy that works on Tesla here. So where I'm going to start is in the strategy tester. And I'm just going to search Tesla model. And here are my three models, right? And they're pre-built, entry and exit criteria, ready to go. Now, when you're testing a model, you're going to get an alert here at the bottom, and it says, don't trust back-tested results on training data. The model was built using this section of the chart from June 2022 through July 2023. It is custom built for that section of the chart. We don't want to strategy test on that section of the chart. We want to choose a section of the chart that the data or that the model was not built on. And really what that leaves is two big sections. It leaves the period after July 2023, essentially any time from after July 2023 until now, or it leaves this section of the chart basically from the June 2019 lows all the way to about May 2022. Now, I know that Tesla existed before 2019, but I think most of us here would argue that Tesla wasn't like capital exclamation point Tesla until 2019, right? It was flat and sideways for many, many years before it became the Tesla that we all know, the big volatile behemoth Tesla. So remember at the beginning, I said I like lots of data. Just right off the bat, I've got a year and a half of data from June, or rather July 2023 till now, and I've got 3 years of data from June 2019 through May 2022. So right off the bat, I'm instantly more drawn to wanting to try testing on this section. The other reason why is simply because there's just more volatility in this particular section. You know, if you zoom out, yeah, it looks up only, but there are huge drawdowns during this section. There are huge periods of sideways consolidation during this section, right? This thing's got a little bit of everything. Whereas over the past year and a half, except for really month, 5 weeks, 5, 6 weeks, Tesla really just went sideways and down. So I think it's better to test on more data, and I think it's better to test on more varied data. So I'm going to test it on this section, June 2019 through May 2022. So we'll do that real quick. In the strategy tester, I'm just going to define the date range. We'll make this June 2019. We'll make this May 2022. And we'll say apply. And literally in like 2 seconds, we're going to get the results of this strategy. And we'll see how it does. All right. So pretty not very good results, basically. You got a 7.7% return versus the asset over the same period of time, 2,300%. Like this is just, this is not enticing really at all to me. A 51% win rate. We're actually getting no go highlighting here. Let's move on, right? We don't need to think about that much more. Let's just bring in Model 2 and see how Model 2 does. Again, we're going to adjust that date range to June 2022, or sorry, June 2019 to May 2022. And we will apply. Okay, a little bit better. Not much better, but a little bit better, right? 60% return. Looks like we're taking quite a few more trades, 114 trades. Max drawdown is, it's okay. It's definitely better than the max drawdown on the asset. Things are getting better. They're not dramatically better. I know that nobody's going to be really excited by this, but they're a little bit better. It gives us a little bit of something more to work with. A little bit of some, we're understanding more about the model, right? Let's try model 3. And again, just going to select that date range, June 2019. Through May 2022 and run the test. And the performance gets really bad. Negative 2.6%. Okay, so we have arrived at a crossroads, have we not? The results of our 3 tests are pretty darn underwhelming. Before we go getting discouraged, I want to say this is a really, really common part of the process when building AI-driven strategies. Early models often need refinement. So the key for us now is to use this as an opportunity to learn and improve. The question that we need to ask ourselves now is, how do we move forward without just completely starting over from scratch? I'm not willing to start over from scratch. There's a few things that we can do. We know for sure that Model 2 gave us the best results, right? 60% return on Model 2 versus what I forget, it was like 7.5% on Model 1, and this one was just negative, no good. So the first thing that we can do is we can utilize this try other model types button. When I hit that, what it's going to do, we have 4 different AI models that we can choose to create with. Again, like I said, Russ talked about this in the last webinar that we did, but we've got a linear regression model, we've got a naive Bayes model, we've got a random forest model. And so it's going to take those parameters that we defined and it's going to run them through all those different model types, and we're going to get some new models back. Sometimes those models might turn out to be interesting. Sometimes they might not. In this particular case, we got 2 models that don't look very good. Remember, I like to get rid of models that don't look good, so I just go ahead and delete them. I'm going to let this one continue on. Random forest usually takes quite a bit longer than the other model types. Now, the other thing that I can do is I can crossbreed models. Whenever you build a model, if you have multiple models that use the same training data and the same model type, you can do what's called crossbreeding. And in crossbreeding, essentially what you're doing is you're taking the best, the worst, random inputs. It's just creating new generations of the model. So we can crossbreed all 3 of our original models. We can choose to just crossbreed maybe 2. We know that model number 3 didn't turn out very good. Maybe let's just crossbreed the first 2 and see if that yields us anything. So we'll let those work. In the meantime, our random forest model has come back. And again, doesn't look all that good. Not worth it to keep it, in my opinion. We'll go ahead and get rid of it. So we should get a new set of 3 models here in a very short period of time. And we'll see what it yields for us. I never really know what it's going to do. Okay, so instantly, 2 models look bad. Let's get rid of them. And then we got 1 model that kind of looks similar to the rest of our models. So, you know, we've done a little bit of additional work here, and we've come to find that those processes that we just took are yielding, at best, a model that looks about the same. So maybe what we need to do, we could continue crossbreeding. That is absolutely something you can do. We've found some pretty decent results by crossbreeding multiple generations. So absolutely consider going down that road. I want to walk us down a slightly different road. Remember at the beginning, I said that we need to use our knowledge as traders and apply that knowledge to our models. Well, I think that this is our chance to do that. So let's take a step back and examine what might be missing in the models that we have. I'm just going to go ahead and delete this one again because it doesn't look too much different from the first three. What do we know about the three models? We know that they utilize stochastic K. All three of them find stochastic K to be the most important. Two of them find the MACD histogram to be the most important. And then you've got RSI over here. So three main indicators: stochastic K, RSI, MACD histogram. Since we just released that video last week where we used RSI in the lab, I want to avoid using it here and instead focus in on stochastic K and MACD histogram. What do we know about those indicators? Well, for stochastic K, helps identify overbought and oversold conditions, which is useful for spotting potential reversals at extremes. However, it is less effective at detecting momentum shifts within trends because it's tied to price range over a fixed period and it tends to oscillate relatively predictably. The MACD histogram, on the other hand, it's built specifically to track momentum changes by showing the difference between the MACD line and the signal line. This makes it excellent for identifying shifts in the pace of a trend, but it has a drawback. It is more reactive to short-term price changes. These small fluctuations can make the signal choppy or harder to interpret. And we know that models work best when they have clear signals. So perhaps one way that we could manually clarify the signal is by adjusting the histogram and perhaps creating like a smoothing of it, a moving average of it. Theoretically, this might help us reduce some noise and make the momentum signal a bit clearer and a bit more stable. This should help distinguish meaningful changes in trend momentum from insignificant blips, which also should then give us more reliable foundation for the model. Additionally, this approach does build on that principle that we explored in the RSI video that we released last week, where we used multiple RSI lengths to add context and stability to the model. By smoothing the MACD histogram, we're looking to potentially enhance its reliability, which I'm hoping will allow the AI to focus on clearer, more actionable signals. So let's do that. If we go back into our model, I could choose this one or this one. They both have stochastic K and MACD in them. I'll just pick this one. If we go into build up on it and then click model inputs, I'm just going to remove all of the inputs except for the stochastic K and the MACD histo. Now, I'm not going to go too deep into the process of how to build formulas here. We do have documentation about it. My guys are going to link you to that documentation. But we want to create, if we want to create a smooth version of this histogram, the way that we'll do it is with a custom formula. And very simply, you just type in MA and then a parentheses, and then you define the input that you're referring to. In this case, I'm referring to input B, the MACD histogram, and then comma length, and then close out the parentheses. So now I've got a 5-period moving average of the MACD histogram as one of my inputs. Now, hearkening back again to that RSI video, I use multiple RSI lengths. Maybe I want to use multiple MACD histogram lengths here too. So I'll just duplicate that and change this to 10. So now I've got a 5 and a 10, a short and a slightly longer. And I'm going to start training the model again. And we're going to get a new model based on just those two simple inputs and those two moving averages. Now, at the surface, this doesn't look dramatically different from the models that we already made, right? And you might even argue it's got a smaller green area. Maybe it's not as good. But what I notice is that there are more signals here. More signals means more potential for data, which I like. So I think that at this point, it's a good idea to go ahead and deploy this and see how it does. Maybe, just maybe, the change that we've made with the histogram, maybe that does make our signal a little bit cleaner, and this model will, be able to find better places to get into trades. So I'm going to say deploy. We'll call this Tesla model number 4 and proceed. And then again, going into my strategy tester here, Tesla Model 4, ready to go. And all I got to do now, pick a date range. And again, we're going back to 2019, June of 2019 through May of 2022. and apply. Let's hope this works. So now, when we test this new model on that same data set, we're getting results that are certainly more appealing than the results of our previous models, right? Now we've got 153% return. This is a good sign. It suggests that we should at least spend a little time refining this model a little bit further, or refining the strategy of this model a little bit further. Well, how do we do that? Well, my first thought is to go into the Price Behavior Explorer here. Um, there's a lot going on this chart. I'll talk very briefly about what you're seeing here. Again, we have documentation that you guys can learn more about this stuff. But essentially what we're seeing here, we've got our winners and our losers, our raw data of winners and our raw data of losers. I'll turn these off so you can see what they're referring to. It's essentially just these dots and these triangles. You've got a couple of clouds in the background, which is the range of 96% of your losers, the range of 96% of your winners. And then we've got a random control line. Now, the first thing that I notice here, remember, this is utilizing those parameters that we defined: a 4% take profit, a 4% stop loss, and a 10 candle window. If we look at the take profit at the top here, we see some triangles, which means that these are the positions that are getting out at our take profit. Down here, we see some triangles, which means these are the positions that are getting out. Our stops are getting hit. And then over here on the far right, we see just a ton of triangles. Way more triangles over here on the far right than we have up at the top at our take profit, or that we have down here at our stop loss. What this is saying is that we have way more positions that are getting out before a take profit or a stop loss is hit. They're just simply getting out because 10 candles have elapsed, and that's what we've defined. The question that I have now is, well, what happens if I remove that 10 candle window and I make it so that the only way one of these positions can get out is if either a take profit or a stop loss is hit? I got to try. So let's do that. I just remove that condition, rerun the test. Okay, starting to get a little bit more interesting, right? Now we're at a 546% return versus 2,300 on the asset. Yeah, I get it. It's not nearly as good as buy and hold, but we've made progress. We've increased our return by 392%. Not bad. Our win rate has gone up 12% to a 65% win rate. Our max drawdown is not so bad. Average wins looking pretty good, right? Things are looking pretty decent. Now we go back into the Price Behavior Explorer and we do further analysis. Now that we don't have that restriction of the 10 candle window, now we're only seeing what positions are getting out on a take profit and what positions are getting out on a stop loss. And there are two key things that I can see just right off the bat when I look at this chart. The first thing, notice how many triangles I have above my 4% take profit line. So any triangle that's at that 4% take profit, that means it's literally getting to 4%. The candle's closing, I'm getting out of the trade, and I'm getting my 4%. Any triangle that appears above that line, what's happening there is the day is closing, I'm still in a trade, something is happening overnight, Tesla is opening up higher, and I'm getting out when that first candle closes, and I'm getting better than a 4% return. And I actually see a lot of trades in which that's the case. That's kind of interesting. And it kind of suggests to me that perhaps my stop, or rather my take profit, is too tight. Maybe I need to loosen my take profit, maybe increase the take profit so I can kind of capture. I mean, I am capturing these trades, but what would happen if some of these trades I'm taking profit at 4%, what if those could continue to increase as well? If we look down at the stop loss, I don't see the same scenario. Yeah, a couple of trades I'm getting stopped out at a lower, or at a bigger loss than 4%, but for the most part, they're all hitting that 4% and stopping out. That's the first piece. The second piece that I notice is that the lion's share of my trades are really kind of occurring in this section of the chart. If we look at the axis down here, this is candle time. So 1 candle, 5 candles, 10 candles, 20, and so on. Well, at about right here, it looks like the amount of positions that I am still in kind of falls off. Yes, I do have positions that continue on well out into the future, but the lion's share of my winning positions occur in about the first 25 candles. So what if I bring back that candle window that limitation and say, you know what, after 25 candles, I want to get out of this trade no matter what, because I know the amount of trades falls off. And maybe by getting out, I can get re-triggered back in at a different time, and I can kind of take advantage of more of the alpha that I'm seeing here. So the next step is to slightly increase my stop loss, like I decided, and then I'm going to add back that candles past requirement, but make it 25 this time and rerun the test. So interesting. Things are getting better, right? When I made those two little changes, my returns just went up like 400%, 350%. My win rate's still nice and high. I'm taking a ton of positions now, 144 positions. My max drawdown is really, really safe and like this is really, really palatable, 19% versus the buy and hold max drawdown is 63% over the same period of time. How can I make it better? The next thing that I want to do is I want to go into the performance chart here. And there are really two key things that we're looking at. This is my equity curve, nice, smooth up and to the right. And then this is the asset, crazy volatile Tesla. Anywhere that's green on this chart is going to be a position that I took where I got out at a take profit. So I made some money on that position. Anywhere that's red on this chart is going to be where I was stopped out. And then anywhere that's white on this chart, where we just see the line, that's where I'm not participating. And the first thing, the literal first thing that I notice here is that in these big, gnarly, powerful up moves, look how little green you see. That means I'm not taking advantage of those big, powerful up moves, right? I'm in a lot of trades when things are pretty choppy, when they're going up. I'm in the trades throughout. When things are choppy to the downside, it looks like it's avoiding. When things are strong to the downside, I'm not in trades, but I am just missing out on these big, parabolic, powerful momentum moves higher. How can I take advantage of some of that stuff? Well, clearly I need to increase my take profit and I need to increase my candles past my window again because I'm missing something, right? Like I'm getting into trades. I see that I'm getting into trades at the start of these things. I'm getting into trades throughout them, but I'm just not staying in the trades, which means I'm missing out on those extensions. So the only way to take advantage of them is to start pushing the limits here. So now we start getting a little, we start pushing things out. We start trying to extend these things a little bit more. So I've increased the take profit from 5 to 8. We'll see how that changes things. I don't know what it's going to do. Okay, interesting. 1,060% return. We've increased now by about 160%. Not bad. What happens if we push that a little bit farther and we extend the candles past, push it to 30 candles past instead of 25? What do we get then? Okay, 1,400, right? Things have gotten better. If we look at our chart here, we're starting to see more green, especially in this section of the chart. Looks like this position has stayed in a little bit longer as well. I don't want to get into too deep analysis here, but just generally speaking, this section for sure is quite more green. Let's push it just a little bit farther. Let's see if we can push this thing, make it a little bit better. All right, 1,700%. So now we are getting, gosh, we're like pretty close here. We could play around with it more for sure. We're definitely in this trade longer, definitely more green in here, but this is getting pretty darn good. At the start of this process, the results from our initial models, they weren't very inspiring. In fact, they were kind of quite the opposite. They almost made you want to quit. But just through a little bit of iteration and refining inputs, leaning on our knowledge that we already have as traders, right? We've taken what seemed like a pretty underwhelming strategy. We've turned it into something that can actually pretty well compete with buy and hold. The key difference here is risk, really. That's what it boils down to. Instead of weathering this 63% drawdown over the course of this 3-year period that comes with just buying and holding Tesla, our strategy really manages to deliver comparable results. I don't know anybody who would be bummed with a 1,700% return over that same time. It delivers comparable results, but it significantly reduces our drawdowns. So in other words, what we've done is we've found a way to participate in one of the most historically volatile assets in just a much safer, much more controlled way. Now, since we've been releasing, documentation, or not documentation, but content with using this tool, and specifically going through the process that I just went through of just kind of like finessing the exit conditions a little bit. We've gotten some questions about, how close are we getting to curve fitting here? And I think it's a fair concern anytime you see big improvements in back tests. But here's why I'm confident in what we've just built. The process itself is what makes the strategy robust. Rather than force fitting inputs to historical results, we used a combination of data driven insights and then our own internal trading logic to refine this model step by step. And what this does is this gives us a clear set of next moves that we can take. If we're really concerned about that curve fitting piece, there's a couple of ways that we can go about addressing it. The first is we can just simply explore new opportunities, right? We can take the foundational logic that we've just built here and we can apply it to other assets to see if this strategy can deliver similar or better alpha elsewhere, right? If this were so fine-tuned to Tesla, then it probably might not work on anything else. Well, we can test it really quickly with a tool called the Variance Explorer. I'm going to go ahead and save this strategy really quick, and I'm going to open up the Variance Explorer here. And so by saving it, the strategy is inputted. What the Variance Explorer allows us to do, it allows us to test a multitude of things at once between different strategies, different time frames, different assets, different depths, right? Up to 52 variants at once. So what I've done is I've inputted that new strategy we just created. I'm going to test it on a bunch of different time frames from the 15 to the 4-hour. I'm going to test it 7,000 candles back. So we're going to look at a lot of data, and we're going to test it on every other name in the Mag 7. Maybe it could work for one of them. Maybe it might work for one of them even better than it works for Tesla. Very quickly, we're going to get these results back. And what we find right off the bat, Netflix 4-hour. This strategy actually beats buy and hold on Netflix 4-hour by like 570% or something like that, almost 600%. Pretty impressive. If we were to go down the results here, there's actually a couple of different names on a couple of different time frames where the strategy does really well. So that gives us more things to explore, right? Maybe we could go and fine tune this for Netflix 4-hour. The other thing that we can do with this strategy, now that it is ready to go, is we want to go ahead and forward test it, right? We want to see, well, we tested it on historical data. How does it perform from now over the next 6 months? We can utilize TrendSpider's trading bots. We can just launch this strategy as a trading bot. And with the trading bots, we can get just signals to our phone, to our email. We can connect it to a brokerage via webhook so that we can trade it, whether it be take it live or through a paper account. We can create alerts in the platform so that we're alerted every time the model gives us a signal, right? So in closing, creating a successful AI-driven strategy is not about instant perfection. I think we've proven that today. It's about iteration, experimentation, and refining based on what the data tells us. What we've done here, exploring how to leverage the AI Strategy Lab to build, test, and adapt models, it's really just the beginning, right? And I hope that you guys, the big takeaway from this, I hope that you guys walk away understanding that every failure, every underwhelming test result is just simply an opportunity to learn and improve. The lab is a tool, and the power in it lies in how you wield it. It shifts your role from being a staunch rule maker to more of a strategy refiner, and hopefully empowers you to focus on uncovering actionable insights rather than getting bogged down by the mechanics that get you to those insights. By embracing this process, trial and error, observation, adjustment, you can craft strategies that are uniquely tailored to your style and the markets that you trade. So as you leave here today, I want you to remember, the most successful traders are not those who avoid mistakes. They're the ones that learn from them and adapt. The AI Strategy Lab gives you the framework to do just that. It turns every challenge into a stepping stone towards becoming a more efficient, more knowledgeable, and hopefully more confident trader. So I'm going to pass the baton now over to you guys. It's your turn to experiment, to refine, to create new models. You never know. I mean, like your next breakthrough here might, or your next breakthrough in trading might just be one test away. And I'm going to also encourage you guys as you find stuff, as you play around. I really hope that you'll share it with us. Share it on Twitter, tag us in the Twitter posts. Let us know what you're working on. Hit us up in chat in our customer support chat down here using the contact us button. Let us know what you're finding. We'd love to see, the ways that you're using the strategy lab. We could get inspired together.